think the first and most important change is there's probably less than a handful of new firms that are coming on stream. Obviously, the fact that the equity valuations on the markets, on the public markets, are so low is attracting private equity interest into the space. But having said that, I personally doubt that the pool of private equity that's dedicated to metals and mining is going to expand in a meaningful manner. It's been, if you look back over the last 10 years, it's been a pretty stable community of private equity firms and capital that was allocated to the space. I mean, up to today, it's basically a handful of funds that have genuine, meaningful capital to deploy into that space. There are probably going to be less than a handful of new funds. We also see increased interest from mainstream generalist private equity firms to deploy capital in the metals mining space. I am personally unsure how sustainable that interest from the mainstream generalist private equity funds in metals and mining is going to be. They want to play the game more in a leveraged buyout manner, like bidding for very large disposals of mining majors that are already cash flowing. And those types of opportunities kind of usually only open up once in 10 years or so. So I don't think that makes for a sustainable business model. The way how we and the other sector specialized funds that are in the space think about this business is that metals and mining is like a perpetual M&A machine. The large companies and the larger mid-cap usually resort to M&A to fill to replenish the project pipelines, right? So somebody's got to do the job to actually nurse all these new companies and projects that will later become part of the global supply pipeline. And then somebody got to give the capital to those entrepreneurs who are going to build these new companies that going to later become part of the global supply pipeline. And that is an activity that I think the larger mainstream private equity firms are not going to embark on. I think they're going to rather target the very large disposal of a major asset from a major mining company. I don't think they're going to play on the entrepreneurial end of the spectrum, like we do, and the handful of other funds do as well. So all in all, I think there's not going to be a dramatic impact, frankly speaking. I think the pool of private equity capital in metals and mining might expand globally by maybe $3 or $4 billion, but I think that's it. No. If you take a very successful year from the public market perspective, for example, I think 2007 is the reference here I have in my mind right now. I think the global junior mining IPO raise was $20 billion every year then, right? Now it's less than $4 billion, right? The total pool of capital, private equity capital, that can still be deployed to that space, which is different from fund size because a lot of the funds might already have been spent, right? I would say the pool of still deployable capital I estimate to be between $6 and $8 billion, right? That might look large when you compare it to the current public market raisings, which is about $4 billion. It, however, looks very small when you look at the kind of bull market capital raisings, which was about $20 billion a year, right? And then you shouldn't forget that the pool of private equity capital does not renew itself every single year, right? So usually a fund goes out to raise a new fund once they have spent 75% of your capital, right? So let's assume you need 2 or 3 years to commit all the capital out of one fund. That means that pool that's out there today, those $8 billion, in reality translates into something between $2 and $3 billion of capital availability every single year on average, right? That clearly is significantly less than what the sector was used to be able to raise from the public markets. In my personal assessment, and there are no clear statistics, but in my personal assessment, especially the early stage, the exploration side is about 90% underfunded versus what it was before, and in my opinion will remain so for the next 3 to 4 years. The development side, in my opinion, is also at least 60% underfunded compared to what it was before. Sorry, can I just interject one more further? And maybe private equity shouldn't fill the whole funding gap, the equity gap that's in the market, because a lot of people, including myself, would argue that a lot of companies were listed and raised capital that shouldn't have been listed or shouldn't have been able to raise capital. So like in every exuberant market, there's usually also a lot of poor quality assets and people that get financed, right? And maybe part of what's happening right now is actually a cleansing process of the industry, where those projects that are poor fail to raise further capital, where those projects that are too risky fail to raise capital, where those management teams that frankly speaking shouldn't have been able to raise capital now finally run into a brick wall. By definition, a mining project is a finite life asset. Eventually, its life of mine will expire. That translates to the corporations that own those assets. So, by definition, their ongoing portfolio of mines will reach the end of its life of mine eventually. So, there is a permanent need for every single mining company in the world to replenish its project pipeline. Now, we are right now in an environment where the very type of exploration and work program budgets that generate that project pipeline of the future get slashed, right? Starting with the very big corporates, they're closing down, like BHP Billiton, de facto closing down their exploration business, and the junior mining sector is not able to fund exploration programs anymore by and large. So what it means is actually that somebody has kind of basically pulled the plug on the funding that is necessary to replenish the project pipeline. So while the current situation, and my view on this is more conservative than most others, while the current market downturn might last another 3 to 4 years. And by the way, I've been wrong before in some of my forecasts, so we might have this conversation a year from now and you say, hey Bert, you told me that it's going to last another 3 or 4 years. That's what I believe at the moment. Might be right or might be wrong. So anyway, for those who are able to raise the money, to do the entrepreneurial job, to create those projects that will constitute the future supply pipeline, they will have a great time and make a lot of money, because the day will come when those projects are gonna be needed. That day is gonna come, and this is why I say it's the opportunity of a decade, because the quality of assets that you can pick up at lower than usual prices has significantly increased. But it's not only the quality of assets; it's also, and the cost of getting into assets. It's also the cost of the execution of work programs. You got better people available. In the contractors, it's easier to get hold of the A-teams. It's cheaper to drill right now, it's cheaper to mobilize a drill rig, and the capex rates have gone down. So all in all, also the execution of the work programs actually has become much cheaper than it was only 2 years ago or 18 months ago. So it's a huge opportunity in a very capital efficient manner to create the project pipeline of the future. And those who succeed in doing so will make a lot of money. It's all about people. We are a very people-driven firm. It's the people who build the business, not the assets by themselves. It's people who create value, not the assets by themselves. So putting that aside at the moment, that is the single most important criterion for us. Who are the people? What is the quality of the people who we're actually backing with capital? So, but putting that aside and zooming in on asset quality, when our capital through the management teams who we back actually flows into assets, and that is really, it really goes back to first principles. Lower half on the cost curve, low capital intensity, a permitting regime and period that is realistically manageable. It really, really flows back to those very first principles. Nothing too complex, no complex metallurgy, no associated technology risks. It's really simple actually. Because we take the view actually no matter what metals or mineral you invest in, as long as it's low on the cost curve. In our case, the cutoff grade, a little bit unscientifically, is roughly midpoint on the cost curve. As long as it's low on the cost curve, as long as the ultimate capex to build it is somehow manageable, as long as the project successfully stress tests against the capex overrun scenario, as long as the project has a survival strategy at trough cycle prices, either because it's low cost enough to break even or because there's a cheap and easy executable mothballing solution, whatever it is, right? So once a project ticks all these boxes, and that goes really back to first principles, in our view, is a viable project. I have two different utility functions from attending conferences. The first one is always a great networking event because mining conferences are usually a good excuse for all the executives of getting together, because to meet the same critical mass of people who I meet here would usually have to spend 2 or 3 weeks traveling, and so I came back in 3 days. So it's just the networking utility that comes from attending a conference. The second one is also because private equity is unusual and not really well understood in the metals and mining industry. We think, and I'm not speaking here just for Denham, which is the fund that I represent, but I speak actually for all the private equity funds active in this industry, I think it's actually really important to explain ourselves, to explain what we do and how we actually really do it to a large audience of entrepreneurs and companies. Because everybody understands the public markets very well, everybody understands reversing your assets into a cash shell very well, everybody understands that game very well. Only a minority of people really understand private equity very well, which is not surprising given that private equity is not a mainstream form of funding in metals and mining. Now, the bigger debate is it going to become a mainstream form of funding in metals and mining? In oil and gas, it certainly has become the mainstream form of funding, especially in the US, where literally only a handful of people go to the stock exchange and list, and everybody else tries to tap into the $65 billion pool of US oil and gas private equity. In metals and mining, I don't think it's going to expand that much, and the reason for that is it's the risk profile of the industry. And it's also, frankly speaking, the skill shortage in the industry. Metals and mining is very, very, very skill-starved industry. Now, I don't have the stats precisely in my head, but over the last 25 years, the number of geoscience graduates has halved, while the number of mining projects at various stages of de-risking, exploration, development has quintupled. So when you take a look at that curve, skill sets gone down like that, number of projects gone up like that. Then you have this huge skill gap in between, and then you compare that to the reality that it takes 20-25 years for a mining engineer to really know what he or she is doing. That it takes 20 years of kicking the rocks for a geologist until he or she really understands what it is that they're doing. That it takes 20 years for a metallurgist until he or she really know how to best get to the optimal metallurgical outcome, right? So I think there's a generation of people missing. There's a new young number of people coming out now who have seen what the mining boom can do, and they get very active and very excited, enthusiastic, and gang-ho about it, and it's a good thing. There's the really older people who have been around the block for a long, long time. They have been there when the mining industry was in a nuclear winter in the early 90s, in the mid 90s. They know how it looks like when gold was at 250 and copper at 70 cents per pound. Unbelievable from this perspective almost. And so you have those people around, but there's not many people in the middle. And it's because of this skills shortage in the middle that the industry has by and large an execution problem. I think that also kind of speaks to the significant capex overrun that the industry experiences, but it also means that the number of real professionals who can actually assist capital in this industry, funds, also the number of real high quality people who funds can access is actually fairly limited. So I think unlike in oil and gas, there are certain growth obstacles that, in my opinion, will prevent private equity from becoming a large-scale mainstream force of finance in metals and mining. But hey, I might be wrong.